Now here's Mo with more on Market Wrap.
Welcome back, everyone, to Market Wrap. I'm Mo Ansari, president of Compact Asset Management. So now let's go to our guest line and talk to someone about how to get rich. That's basically how to prosper in today's day and age. On our guest line is Mr. Greg McBride. He's a chartered financial analyst, chief economist at bankrate.com. Mr. McBride provides analysis and commentary in the area of banking, personal finance, and consumer trends. In addition to his frequent contributions to Bloomberg and CNBC, you can get his insight on a frequent basis right here on Market Wrap. Greg, welcome to Market Wrap.
Thanks for having me, Mo.
Greg, it's always wonderful to have you on the broadcast. Great research that you do at bankrate.com. Bankrate just released this poll showing the majority of Americans think that wealth is beyond their reach and will become even more difficult to obtain in the next 10 years. In your opinion, why? What is the biggest reason for this mindset? What has happened?
Well, there's a few things. I think a lot of this is just a reflection of these low levels of consumer confidence, the high rate of unemployment. Some of the reasons that people cited were too many bills, not enough income. Joblessness was another reason. But I think at the end of the day, what really tells the figures is that there's a disconnect between what people are actually doing in order to create wealth. I mean, 75% said that they had cut back on spending to save more, but only 52% actually are saving consistently. And of course,
they
building
think
wealth
they're saving, but they're not really saving. So it's just too many bills, not enough money. That's really that's what people are saying right now. But what are the main obstacles that you see them from getting rich? Because in this country, in America, that's what makes this country so great. Anybody can become wealthy. Anybody can do it. That's really the case. But why are so many people getting so pessimistic?
I think a lot of it has to do with this roller coaster ride that you alluded to a moment ago that we've had in investment markets. I mean, people said, what's the most likely pathway to becoming wealthy? People said high-paying job or starting a small business. When it came to, investing, only 12% felt that investing well in stocks and bonds would provide them with financial freedom. Only 9% thought that investing in real estate was going to get them there. And so, again, I think there's this natural pessimism about investments. And I mentioned that disconnect on people that are actually saving. Look, starting a small business, that has been proven as a way to wealth for those that work out, but it doesn't work out for everybody. I think the factors you can control are things like keeping your debt under control, living within your means, and saving consistently. That's where the disconnect comes in. People that say that, yes, I'm doing what I can, but when the rubber meets the road, it really boils down to, they're not saving consistently. They're not making themselves accountable to control what they can control in building wealth.
It's just people say, well, if I had a better job and I made more money, I would get wealthy. It's not that. It's putting away some of that money that you make and paying yourself first. 11% blame credit cards. Did that surprise you a little bit?
Not a whole lot. I mean, it's we all know that the American consumer, by and large, has been dining on debt, for more than a decade. And now those chickens have come home to roost. And, it's a situation where credit is not available to the extent that it was. And it's a reality check for consumers that have had to dial back their lifestyle. They're now grappling with higher debt. And they're really starting to feel the pinch, whether it's from the job market, just the fact that they've had to cut back their lifestyle because they can't lean against credit to sustain that lifestyle. And they're having to confront that debt head on and actually pay it down. I think that you're seeing all those factors reflected, but the fact that 11% said that, I don't find that terribly surprising.
Let's talk a little bit about government regulation, financial regulation. Right now, I talk to a lot of people, and I know the Obama administration was so concerned about health care, which is dead. It's history now. That's the way I look at it. At least the president said today it hit a buzzsaw. That's the president's words, but that's gone. I think. Do you think the administration had the focus in the wrong place when they started health care first? Well, Main Street was worried about the economy, was worried about Wall Street, where the government is giving all this money to Wall Street. Street and was not getting to Main Street. And do you think they should have fixed Wall Street, got the regulations first, and did the financial major overhaul of the regulation, because that's what caused the problems in the economy? And do the people feel that the government has not fixed those problems yet?
I think that's, and I'm not a political handicapper, but I mean, I think that's the realization that's now setting in Washington, it appears. And, you're starting to see, just within the past week or so, a couple of things. You've got this new bank tax that's going to be levied on the 50 largest financial institutions, and you've also got this goal of separating, once again, commercial banking activities from proprietary trading, so that theory being that the banks can't take a lot of risks with, and be able to fall back on the taxpayer net. I mean, it gets at the populist anger that people have, but at the same time, let's look beyond that. And, there were a lot of entities that don't fall under that umbrella that were at the center point of what we saw economically. I mean, you look at subprime lenders that were not subject to banking same regulation that banks were.
Mm-hmm.
A lot of the entities, investment banks that are now classified as banks, they only changed their charters after the fact. A lot of examples of institutions that would not have fallen under that regulatory umbrella took a lot of risks, and some of which may not even be subject to these new rules. So, it strikes a chord with people that are outraged and angry, but at the end of the day, is it something that's really going to work? I think there's sufficient ground for skepticism there.
I agree with you, Greg. I think they need to do something that's much more comprehensive than these taking a BB gun and trying to kill an elephant with it. It just don't work. I mean, they've done the Credit Card Act, which is great. They've done some of this other regulation, but we need to bring credit default swaps, which is trillions upon trillions of dollars, bring that into the day of light, so it's not just done by these banks on the side. It has to be brought onto a market that is completely transparent and everybody knows what the credit default swaps are worth. That's one thing they can do. And second, they can cut back on the leverages that banks were able to do, where they levered, they went up from 12 times leverage, they could go up to 40 times leverage. They bring those leverages down, besides some of the proprietary trading. If they bring some of that down, I think that will change where the banks can take risk. And again, if they take risk, they do it with their own money. And if they do take it with their own money and get into trouble, then they should be allowed to go bankrupt, just like anybody else in the country that takes excessive risk and fails. Let's talk a little bit about the Bank Credit Card Act, because it is changing things a lot for the consumer and credit card companies. But there's so much fine print and jargon. It's like sausage making in Washington. When you read that whole thing, it's really hard for consumers to figure out what's really going on and what's going to affect them on this Credit Card Act. Could you clarify some of that for us?
Well, to your point, Mo, just to show how involved it is, when the Federal Reserve issued their final rules that basically lay down the law that was in this Card Act for the credit card issuers, it was 1,100 pages. There's a ton of fine print, and a lot more to it. I actually ran across a couple things yesterday as I was going through it that I hadn't previously been aware of. So it's just that kind of minutia. But there are a lot of provisions in there really going to level the playing field for consumers. Of course, come February 22nd is when the bulk of the provisions in this new act take place. It's going to prevent rate hikes on your existing balances by cardholders, unless it's an instance where you've become 60 days delinquent, unless that increase is because you have a variable rate card, and even then it only applies to future balances, not your current. There's this opt-in provision for charges that will exceed the credit limit. The consumer has to opt in ahead of time as to whether or not they want those type of charges to be approved. We're seeing a lot more issuers actually just doing away with the over-limit fee altogether.
Right.
And then when it comes to paying back debt, the issuers are not going to be able to apply your payments in a manner that's most favorable to them. They have to do it in a manner that's most favorable to you, specifically applying your payments to the highest APR first. So no more paying down the low-rate balance on that balance transfer. Meanwhile, the purchases you've made are continuing to accrue at a much higher interest rate.
Greg, I want to thank you for taking the time out and being on our broadcast today and sharing your thoughts with us.
Always a pleasure, Mo. Thank you.